In this video, I want to talk about trading in trading ranges, how often half R and 1R moves appear. That means depending on where your entry and your stop is, expecting half that initial risk or 1 times that initial risk is a reasonable thing to do. In fact, it's a high probability thing to do in a trading range. I've got a post here on my blog, zentradingtech.com, and I'm going to go through some of these charts. This is the price action from yesterday on ES, the 9th of June. There was a lot of trading range price action. Now, I always found it very challenging to be in a trading range. I felt like I was doing the right thing, waiting for consecutive bars to buy, waiting for second reversal attempts, looking for small bars at what I thought was the high or low of the range. But it seemed that I was always making mistakes. I seemed to always be taking big losses and I was upset. And so I was unable to remain calm to trade well. Now, here's one of the reasons. First bar of the day is a big bear bar. The follow through is bad. Immediately when you see bad follow through, think trading range price action. 2, 3, not great, but now you've got 3 consecutive bull bars. If you buy above that bar, put a stop down below, see how it missed the 1R target. There were more traders taking profits at half R. You can argue that some traders saw this spike and bought a 50% pullback and they got 2R that way. I'm not going to cover that technique in this video, but for those that see it, great. What about this? 2 small bull bars. 9's good. If you buy above 9 with a stop below 7, you did not get your 1R target. You did get half R. What about on the way down? We're up at the top, bad follow through, small bear bar. Not a great sell this bar. Using this technique means good. Notice it stops at half R. Doesn't go all the way. This is a pullback from this spike. New high of the day. Pullback, traders are waiting for a reasonable buy signal. This bull inside bar is okay with a stop below. Once again, stops at half R. Because we're in a trading range, bull spike with a pullback for a high 1 buy. You can also be in a bear spike with a pullback for a low 1 sell. You could sell below 21. Now these bears, if they sold 21 with a stop above, they did get 1R. The reason I put this trade in here with a stop just on the bar is to remind you that you can modify where your stop goes. I think the stop needs to be up here, in which case it would have been a half R trade, but it is possible to do that if you're confident on your read. And if your entry bar sucks, then you get out. What about this? Now you've got consecutive bull bars, reasonable to buy above with a stop below, getting out at half R. See how high probability it is? One of the dangers on the open is that you take a big loss and then you're trying to get 1R or 2R to get back to green. But the market kind of goes in your direction and reverses. So this could be one strategy you can use. We've got a new high of the day. We've had a 2-legged pullback. We're back above the moving average and we've got a really good buy signal. So for comparison here, I've shown that you could put a stop below that bar and get multiple R. I think the stop actually goes lower, in which case this would have been a 1R trade. But whenever a swing happens on a trading range, the market has changed. Now when you buy this bull bar here with a stop below, now you get 1R. But traders were fading the half R. So when traders get swing profits, it often changes what's happening. That's chart 1. Let's take a look at chart 2. Now you've got a big gap up and you don't know necessarily it's going to be a trading range day. You've got a reasonable expectations because this is a big gap. So the market's already moved most of the day's range. So you're not expecting a big day up here. You're expecting probably sideways to up or sideways. In this case, that's the open of the day. That was right in the middle of the day. Consecutive bull bars on the open. Notice these traders got out at half R. So I'm not saying you should always take half R. My job is to get in sync with the market. I'm looking to see what happened. Why wouldn't those traders have held longer? They were already in scalping mode. Okay, now we've got a good bear bar on 7. Put a stop above that bear bar. Bears get 1R. Interesting. Bulls got half R. Bears got 1R. So there's an imbalance there. If a trader bought just this bar, once again, I've shown you some traders took profit at half R. Other traders got 1 times this bull bar. I think if you're buying here, your stop needs to be much lower, in which case that would have been a half R trade. 21, second entry short, but bad signal bar and then collapse down. So, okay, if you missed it, some might have sold during that bar. You can't sell down here because you're at the low of a trading range, but now you've got a good opposite bar. If you buy that, look what happens at half R. Comes back to your target. This is a really common behavior. We've got 3 legs up, possible wedge, but you're in the middle of a trading range, 3 consecutive bear bars. Now you've got a good signal bar. If you put your stop where I think your stop needs to go, you got 1R on that trade. So from the start when bears were able to get more return from their risk, I think this led to more of this behavior. Now you got 3 legs down in a wedge, you're back at the 200 moving average, and now you've got wedge bottom, breakout and follow through. Buying here, 1R, it might have even gone to 2R up there, I think it did, but you can see at this point, it didn't take off until we went back above the moving average. So I've highlighted this entry as well, saying, well, you got 4 bull bars above the moving average, buy there's your 2R. So you can see when the market's in a pullback, when we're unsure, there's a lot more scalping. And these classic swing entries that Al talks about in his books, these are ones that have got more likelihood of going for swing profits. Okay, chart number 3. So on the open, consecutive bear bars, you have to make decisions when you can't see the rest of the chart. You can see traders that sold the low one below 3. Why would you sell that? Well, this is a weak reversal bar. There's just no need to buy above it. There's no need to buy the close. So we're probably going sideways to down. Notice how they took half R. So good looking low one short, but something's wrong with it. And from here, 9, can you buy 11? Well, we're going down and we're pulling back to the moving average. Now we've gone above, waiting for a pullback to buy. If you bought 12 with a stop below, you didn't get your stop run. But notice how you only made 1R. I haven't marked that on the chart, but if you were here, so you've taken what I think is a low probability trade because you're doing anything in the middle of a trading range, and you only got 1R, and that's usually a bad idea. Now you've got really good looking reversal bar like 14. It's not going to attract many sellers. Now, if you buy above that bar, there's your 1R. Traders that waited for consecutive bull bars, they missed their target. So isn't that interesting? It got to half R and traders kind of tapped out. This is what I mean about trading ranges. You're constantly waiting for it to do more and it disappoints you. So the disappointment is that I'm expecting the swing to form and it doesn't. And rather than sit in a trade that's going nowhere, it's often better to get out and reassess. Now we're at the high of the day, 3 consecutive bear bars, bad buy signal, good looking sell signal, good looking follow through, entry bars, all good. So this had a good chance of going to 2R. Sell signal in the top, buy signals in the bottom. Now the bears have got a 2R, they're probably going to take control. There's no point selling in the low of the trading range. Bulls are able to get half R back. See, didn't go to their 1R. And now more sell signals at the moving average, probably for a second leg sideways to down. See, they got 2R again. So a lot of opens have this behavior, fighting to try and get control. Bears give up here, bulls give up here. And if someone can get a good looking sell signal, this is likely to happen. You even had further signals down here for the wedge. Anyway, I hope you found that interesting. I'm mainly showing this to encourage you to look at trading ranges a bit differently. Trading ranges, even though they don't go very far, seem to take a lot of money from traders, or at least they did for me. I've got some summary notes at zentradingtech.com. You can check it out. Summary being, swing traders are aiming for 2R, but that's rare in a trading range. Half R to 1R trades show up more often. That means this is high probability. And if it's high probability, that's what I should be doing. You have options to adjust where your stop goes, where you scale in, and you can trade much smaller. They're confusing if you expect trending behavior. I said once again, our job's not to predict, it's to adapt. Thanks very much, everyone. I'll catch you in the live trading room for Brooks Price Action, or I'll see you in a future video. Cheers.